what we saw in the peer-to-peer lending was the people that were getting approved is ones that a traditional bank would approve. These weren't they weren't really giving a voice to the underserved customer. And so the question is if we can give a voice to the underserved customer, then we can do something unique and different and make a difference in the marketplace.
Welcome to the Tearsheet Podcast. I'm Zack Miller. On the heels of closing a $250 million credit facility, LendingPoint's Tom Burnside joins us on the show today. The consumer lender has originated $1.4 billion in loans to individuals, targeting an underserved population of people with FICO scores in the range of 580 to 680. Tom talks about the growth potential in servicing this population. We also discuss the firm's point-of-sale loan product and how that's expanded their reach and broadened the definition of LendingPoint's target borrower. Tom Burnside is my guest today on the Tearsheet Podcast.
My name's Tom Burnside. I'm the CEO of LendingPoint. LendingPoint is an unsecured consumer lender. We primarily focus and target as a company. We target a customer or assist a customer that is deserving of credit, but typically underserved. I mean, a couple statistics that you probably know, but one is 80% of all consumers have never defaulted on a loan, but yet 50% of them would never be able to get a loan from a bank. And so we saw a really huge opportunity by really assisting those customers that were in that 580 to 680 space initially from a FICO perspective. And that's really been the mission. My background in this has really been taking technology and data and bringing it together to tell big stories. And so, we started when I worked at First Data, we started building databases of positive activity and negative activity. What we were trying to decipher all the way back, and this is in the 85, 80, 86 timeframe. What we found was we had customers that they had very similar activities. And back in the day, we had actually started with check writers. A check writer had a lot of activity would consider to be a bad check writer, but a check writer that had a lot of activity could be a good check writer because they both have the same characteristics. And so, what we did at that point was start building positive and negative databases, start to understand the customers, make sure that we weren't declining the wrong people, making sure that we were giving the people that deserved the approval. And that really has built over time. We started a company not long ago, a company called Can Capital. That was back in the end of 2000, beginning of 2000. And what we built there was really looking to give money to small business owners that had no way of getting it from the bank. And what we did is we used their receipts to kind of predict their ability to stay in business long enough and give them credit against those receipts. And as a result of that, we had to use a lot of data that was not traditional data. That a lot of these small businesses had really very thin credit. Mm-hmm. And so we start using non-traditional data, even things as simple as a water bill, making sure that we understood that they were using the water, that their business, if they were a restaurant, the business was really growing, and their water consumption was down, and obviously the data they were giving us probably wasn't correct. So we really learned how to use alternative data. One other thing we've done in the past for myself is we automated lines of credit at a casino. So if you go into a casino, that company now is called Global Cash Access. It was a company that went public, recently was taken private again. It's a company I started in the late 80s, early 90s. And what that organization did is we had to take the data information we had at that point and be able to make a decision based on their behavioral attributes on how much line of credit we would give them. And what was taking the casino about 30 minutes to do took us about 12 seconds. So data and technology has been really in our veins, and really taking data technology to understand credit and risk. That's really that's what we do.
So I also like this theme of identifying user behavior and trying to extrapolate, information from that. I'm curious, so it's 2013. You've built Can, and now you're thinking about starting a new company. Well, what was the thinking going, I guess, into consumer away from a business borrower?
Yeah. So, maybe it's a little bit back to my roots. I retired in 2013 from Can Capital. The company was looking to consolidate their operations, their senior management team in New York, and it was an opportunity for me to, it was an opportunity. I had done a lot, had been there from the company from the very beginning. I was the president and COO for all that time. And what I was able to do, is just to kind of step back and look at other opportunities. About a year later,
retirement.
I'm sorry.
Not a long retirement, Tom.
No, not a long retirement, which is good.
Yeah.
My wife didn't want me at home anymore.
Uh-huh.
So what happened was we met some awesome people, obviously, in our journey when I was at Can Capital. One of those was a investment, a family office, and we opened up small business lending in the DR. That business has done amazingly well, sold to Banco Popular not long ago. And what they decided was, boy, Tom, if you're going to retire, maybe there's something else we can do. So they came to my home. They all flew in and decided to visit me at my house. We spent some time thinking about what the big opportunities that were out there. And what we came upon was, look, there's this underserved population of people. You see a lot of at that point was a lot of peer-to-peer lending. This is now in 2014. Mm-hmm. We saw a lot of peer-to-peer lending. What we saw in the peer-to-peer lending was the people that were getting approved is ones that a traditional bank would approve. These weren't they weren't really giving a voice to the underserved customer. And so the question is if we can give a voice to the underserved customer, then we can do something unique and different and make a difference in the marketplace. And so what we started with was looking at that customer, call it up to 700 FICO. It's 50% of the population. If you look at the population today, 690 FICO is and under is about 50% of the population. 691 and above is the other 50%. Mm-hmm. And so there was an opportunity to go give a voice to 50% of the customers in the U.S. that weren't getting a voice prior. And so what we said was, okay, that sounds really good. Now you need the right team. And the nice thing about it, your contact list becomes a little bit extensive, and you get to pick from the people you think are absolutely the best at giving at telling a credit story, putting the data and technology together, and being able to do it in 5 or 6 seconds. And so we set out to kind of create that team. One of those team members was not only my previous partners in the deal we did in the DR, but also we had an opportunity to help American Express start their small business lending. I met a really bright voice there, and Human Montaharian, an amazingly bright voice in credit. And we brought him on initially as a board member, then he became full-time with the business about a year and a half later. So what I would tell you is that getting a voice at getting the voice to the underserved population really started with a team that truly understands credit and data and technology.
That makes a lot of sense. I guess to that point about founding a company in Atlanta, I guess it sounds like you have a lot of resources there. I know Atlanta is kind of a banking software hub. What's it like, kind of building and growing a lending business in that city?
Atlanta has been very friendly to us. I think there's a couple pieces. First of all, the tech side of it and the analytics side of it is really important. We team up with some of the local colleges to make sure we're getting the analytic talent that we need. On the other side, there's a lot of that talent here because roughly about 80% of all processing comes through Atlanta one way or the other. When you talk about the shared globals, the First Datas and others, mm-hmm. So it's a big hotbed for that. And then we chose to be a little bit further on the outskirts of Atlanta, because then all the servicing aspects of the business, our sales teams and customer service and client management, we're able to pull them from a lot of the suburban area. So our pool goes anywhere from Buckhead all the way out to here in Atlanta to the Cartersville area. And it's really been very friendly to us. And, the right cost, the cost of living is still very affordable here. So even we're able to pull talent from other cities, because a lot of times people are looking for quality of life change. And Atlanta's a very friendly city.
Definitely. And I guess I have a question in terms of the target customer. You talked about sort of, you defined exactly who that target is. Has that changed as you guys have grown? And I guess as a follow-on question to that, like how do you continue to market and find those people?
Great questions. Two things I think is important for us. One of them is that where we started the business is really looking at the 580 or 550 to call it 680 really is our sweet spot. That really was where we could differentiate ourselves. This is really where we could make a difference in the marketplace. And as a result of that, your cost of funds, all the things as you get started as a business is very high, right? You don't have much scale. Your cost of your funds are high. Your leverage ratios need to be very low. And so at that particular point in time, that was a great place for us to start and to really understand the market. About a year ago, a little more than a year ago now, we start seeing a customer profile pop up. And what they were saying is, look, can you help us at the point of sale? It started with fertility clinics, which was very interesting for us. And they were looking for a ticket of $25,000 that they were at a doctor's office. They were wanting to have a child. They weren't able to pay for it for cash. And what we saw was a real opportunity there to be able to expand into point of sale. And about a year ago, we actually bought a point of sale platform to help accelerate our movement into point of sale. And as a result of that, because now it's the predictability of the performance of the assets have been very good and very solid, our cost of funds have gone down. Our leverage ratios, we've been able to enhance our leverage ratios. And as a result of that, we're now able to go all the way up to 850 because we have the right cost of funds, we have the right distribution. So now we can take a customer from 580 all the way up to 850 at point of sale. And what we really found was unique there. You remember I was telling you earlier that 50% of the population that wasn't being served. I mean, these guys are the ones that need the money the most. So if you're at a fertility clinic and you have a 660 FICO, more than likely you're going to get declined by a bank or by a traditional lender. In our case, we're able to serve that customer, and not only serve that customer, but serve the customer all the way up to 850. So this has been a little bit of a journey for us. Now where you see us in our acquisitions is you can find us online, whether we solicit you or you go through one of the big aggregating channels, or you can find us at a point of sale when you have a need for a specific product.
Right. So point of sale is an indirect, I guess, you do a deal with the clinic to offer LendingPoint services, right? Otherwise, all the other types of acquisitions are direct to the end customer, right?
That's correct. Yeah. I mean, so, now, you'll see us at places like Invisaligns, you'll see us at fertility clinics, home repair, and then what's really interesting about it, you see a completely different population. At the point of sale, you frequently see a millennial. Yeah, they tend to like fixed payments, fixed terms. And when you look at our direct to consumer, that really is a customer 45 years and older, and they have, completely different needs. They're trying to repair a house. They want to go on vacation. They're trying to repair a car. They have medical bills. So, different uses of funds and, and even different amounts. The millennial transactions like $3,500. The transaction that we see with, call it the baby boomer era and a little bit below is between $12,000 and $15,000. So very different populations we serve now.
And do you service those different populations differently?
Well, we need to, right? I mean, so you have a different group of people in the business. We have a different group of people that service the direct to consumer or that point of sale customer, because there's also a merchant involved with that transaction. And so, when you talk to the merchant's trying to solve an issue or they're trying to understand something on a customer standing in front of them. And so they need real time, somebody to talk to immediately. On the direct to consumer, that transaction typically happens, in 5.5 seconds with a firm offer. If they have any questions, they can chat with us online. Sometimes they can call the sales center here if they want to, but we absolutely service them differently with different groups. By the way, even down to collections. I mean, collections are different. They have different things they're trying to resolve. I mean, one of the things that's interesting in millennial tends not, a lot of these are just hanging a shingle. They're in the gig life. They don't have a permanent check. And so you have to understand how to underwrite them differently. You have to understand how to service them differently. And if they fall off, for whatever reason, go bad for some period of time, a lot of time is because they lost the contract and they're going to get another one. And so we have to know how to kind of deal with their situations differently than we would a customer that's more stable paycheck. Yeah.
Interesting. And I guess so you added in a couple of years ago this point of sale loans. I guess as you're looking out into the future, how are you growing LendingPoint? Are you going to be adding in other types of loan formats? Are you just looking to take what you have today and just keep scaling it? Like what are your growth plans for the future?
What's amazing to us, and we're really just walking through this part of our modeling right at the moment. We see close to 450,000 apps a month on our online business, our direct to consumer business. On point of sale, the point of sale business is growing very, very quick right at the moment. And so, our current products and the way that we approach those customers with the right product set, a lot of it, once you get your rank order of risk, your next one is really getting your products right to be the right fit with a customer at the right time. And so we've been really working on that. We think we can double the business from where we're at today by just making sure we get the right product in front of the right customer at the right time. Then the point of sale, we think point of sale can be as large, could be another $100 million a month, could be just in point of sale, in the next 2 years. And so, we've been doubling the business year over year. We have grown very, very fast. You might know that we made the Inc. We made 17 of the Inc. 5000, and we have grown the company over the last. Thank you. And we grew the business over 9,200% in 3 years. This is there's a lot of room here. When you look at nearest competition, somebody like a OneMain that still does it in a very manual process, but is targeting this customer between 580 to 700. They've got a $17 billion balance sheet, so there's a lot of room for us to grow. We're early in our journey, and we have a lot of opportunity in front of us.
Tom, thanks for sharing with us the LendingPoint story. Appreciate it. Thanks for joining us on the Tearsheet Podcast today.
Thank you. I appreciate the offer.